Good afternoon, sir. My name is Trishna Halder. Here I am present my presentation, and this consent note is I hereby grant permission to ICAPITAL Academy and Corporate Advisory LLP to use the video presentation, assessment test, and MCQs created or provided by me for educational or promotional purposes. This includes publishing or sharing the content on their social media platforms, website, or through any other medium they deem appropriate. I confirm that I have no objection to such use. So my today's presentation topic is that role of technology in modern banking. Technology has transformed banking from traditional branch-based operations to digital-first services. Today, almost every banking activity, from opening an account to investments, happens through technology. This is agenda. This presentation will cover the evaluation of banking technology, major innovations, and their impact on customers and banks. We will also explore digital payment systems, AI, blockchain, cloud, and cyber security. Finally, we will discuss customer service improvements and future trends. First, introduction. Technology has made banking faster, more secure, and accessible to people everywhere. Banking has undergone a massive shift from traditional in-person transaction to digital first openings. Technology now powers almost every banking function from account creation to complex investments. For customers, it means less paperwork and quicker transactions. For banks, it improves efficiency and reduces operational cost. Overall, it has redefined the way people manage money. My second slide is this: why technology matters in banking. So, first, technology enables faster and more efficient operations, reducing wait times and paperwork for customers. For example, instant fund transfers through systems like UPI have replaced manual clearing processes. It helps banks reach more customers through online platforms, enhancing accessibility even in remote areas. Modern banking, however, is powered by mobile apps, online platforms. The difference lies in speed, convenience, and 24/7 accessibility. Objectives of this presentation. This presentation explores the historical and modern technological changes in banking and their business impact. To understand how technologies such as AI, blockchain, mobile apps improve banking efficiency and customer satisfaction. To predict future trends that will shape the banking landscape over the next decade. Fintech companies have challenged traditional banks by introducing faster, cheaper, and more user-friendly services. This revolution includes mobile wallets, UPI, etc. So, definition of modern banking. Modern banking refers to the use of digital tools and platforms to deliver banking services without relying solely on physical branches. It involves technologies like AI for decision making, blockchain for secure transactions, and cloud computing for scalability. And its also revolution includes banking. Banks now collaborate with fintechs to stay competitive. Historical context. Initially, banks relied heavily on manual bookkeeping, which was time consuming and prone to errors. The introduction of ATMs in the 1960s marked the first step toward automation, followed by online banking in the late 90s. Driving factors for technological adoption. Customer demand for convenience and speed has forced banks to invest in digital solutions. Competition from fintech companies like PayPal, Revolut, and Wise has pressured traditional banks to innovate quickly. Scope of banking technology. There are many scope like includes digital payment systems, UPI, NEFT, SWIFT that enable quick money transfer. Also covers mobile and online banking, AI chatbots for customer support, and blockchain-powered security systems. Global banking technology landscape. Leading banks in the US, Europe, and Asia are heavily investing in AI, machine learning, and biometric security. Collaboration between banks and fintech startups is increasing, leading to hybrid financial service models. These tools not only improve operations but also enhance customer experience and security. Section summary. Technology has become the backbone of modern banking, offering speed, security, and convenience. This journey from manual processes to digital first services has set the stage for even more innovative solutions. Evolution of banking technology, early banking systems. Banks relied on paper-based ledgers and manual verification, making processes slow and error-prone. Transactions required physical presence, limiting the speed and reach of banking services. Earlier, banking was slow with heavy reliance on paper-based ledgers. Customers had to visit branches for every service. This limited accessibility and caused delays. Introduction of ATMs. The first ATM was introduced in London in 1967, allowing cash withdrawals anytime. This reduced reliance on tellers and extended service hours. It marked the beginning of 24/7 banking convenience. This reduced reliance on bank tellers beyond the traditional banking day. Telephone banking. Telephone banking launched in the 1980s. This allowed customers to check account balances and make transfers via phone calls. Although basic, it was the first step toward remote banking before internet banking became popular. Internet banking emergence. Internet banking became mainstream in the late 90s, enabling online transfers, bill payments, and account monitoring. Example, ICICI Bank in India was among the first to introduce internet banking for its customers. Mobile banking revolution. With the rise of smartphones, banks developed apps allowing real-time transaction balance checks and bill payments. Features like biometric login and push notifications improve security and user engagement. Payment card evolution. Cards evolved from magnetic strips to EMV chips, improving transaction security. Contactless payment methods using NFC technology now allow tap and pay convenience in seconds. Digital payment platforms. Platforms like Google Pay, Phone Pay, Apple Pay make peer-to-peer and business transactions seamless. Example, Google Pay in India integrated UPI, enabling instant transfers without account numbers. This technology empowered peer-to-peer payments and online shopping. Rise of fintech companies. Fintech companies brought faster, cheaper, and more flexible financial solutions compared to traditional banks. They focus on services like instant loans, investment apps, and digital wallets. For example, Revolut offers real-time multi-currency accounts with real-time exchange rates through an app. Government-led payment innovation. Many governments have launched instant payment systems to boost digital transactions. India's InPay is the best example, allowing instant free bank transfers anytime. This improves financial inclusion, bringing digital banking to even rural areas. Blockchain introduction. Blockchain technology, first popularized through Bitcoin in 2009, is now used by banks for secure and transparent transactions. Its decentralized system helps prevent fraud and enables fast cross-border payments. It has become a game changer for trust and security in finance. Banks now explore blockchain for secure cross-border payments and fraud prevention. Cloud banking adoption. Banks are shifting their core systems and data to cloud platforms for cost savings and scalability. Banks are moving their core systems to data storage to cloud platforms, reducing hardware cost and improving scalability. Example: JP Morgan uses AWS for secure data storage and analytics, enabling faster innovation cycles. AI and machine learning in banking. AI is used for fraud detection, customer service automation, and credit risk analysis. Example: HDFC Bank's AI chatbot EVA answers millions of customer queries instantly. Big data analytics. Banks collect massive amounts of customer data to predict behavior and create personalized offerings. This helps them personalize offerings like credit cards or loan options. For example, Barclays uses analytics to identify spending patterns and suggest tailored credit card offers. Evolution summary. Banking has shifted from manual processes to digital first services, increasing speed, security, and accessibility. Each technological leap from ATMs to blockchain has expanded the scope and convenience of banking. Transition to core technologies. Now focus on specific technologies driving modern banking today. These include mobile apps, AI, biometrics, blockchain, and digital payment infrastructures. Core digital banking technologies. Mobile banking apps. Mobile banking apps allow customers to transfer money, pay bills, online shopping, and check balances in seconds. Example: SBI's Imno app integrates shopping, investing, and banking in one platform. Digital wallets. Digital wallets store payment information for quick online or offline transaction. Example: Paytm in India offers wallet services linked with UPI for instant payments. Biometric authentication. Fingerprint, facial recognition, iris scans improve login security for banking services. For example, Apple Pay uses Face ID for payment authentication. Biometrics reduce fraud risk while making customer access quick and seamless. Near field communication, NFC payments. NFC allows customers to make contactless payments by simply tapping their card or phone on a terminal. This speeds up small value transactions while keeping them secure. Visa Pay, for example, Visa PayWave enables quick, secure tap and go transactions. Chatbots in banking. AI-powered chatbots handle FAQs, transactions, and customer support queries 24/7. For example, Bank of America's Erica chatbot assists customers with account management and spending insights. Blockchain in banking. Blockchain provides transparent, tamper-proof transaction records that reduce fraud risk. Many banks now use it for secure and faster cross-border payments. For example, Santander uses Ripple blockchain for faster cross-border payments. Internet of Things, IoT in banking. IoT devices making banking more convenient through connected devices like smart ATMs and wearables. Some banks even allow smartwatch-based payments or account access. This technology provides banking services in innovative, customer-friendly ways. For example, banks allow smartwatch-based account access and payments for their innovative and customer-friendly benefits. Cybersecurity solutions. Multi-layered security measures like firewalls, encryption, and AI-based threat detection safeguard data. Example: Wells Fargo uses AI to monitor unusual login activity in real time. Robotic process automation, RPA. RPA automates repetitive tasks like KYC verification, loan processing, and data entry. It reduces errors, saves times, and cut cost. For example, Dotsk Banks uses RPA to speed up trade settlement processes. Cloud-based CRM systems. Cloud-based customer relationship management CRM systems store customer data securely and allow banks to track interactions effectively. For example, HSBC uses Salesforce CRM to improve customer relationship management. RegTech solutions. RegTech means regulatory technology. Regulatory technology automates compliance monitoring and reporting. For example, ISD's AI-driven RegTech helps banks detect money laundering patterns. Voice banking. Voice assistance enables customers to perform banking tasks using voice commands. For example, ICICI Bank allows Alexa-based balance checks and fund transfers. Digital KYC. KYC means know your customer. Digital KYC uses video calls and document uploads to verify identity remotely. Example, Kotak Mahindra Bank offers video KYC for instant account opening. API banking. API banking allows third-party apps to securely connect with bank systems and provide integrated services. Open banking in the UK is a good example, enabling fintech apps to access customer data for budgeting or payments. Section summary. Core technologies like AI, blockchain, biometrics, and cloud are redefining modern banking operations. The focus is on improving security, customer convenience, and operational efficiency. Introduction to digital payment systems. Digital payment systems replace cash-based transactions with electronic transfers. They include UPI, NEFT, RTGS, mobile wallets, and cross-border solutions, making payments faster and traceable. These tools focus on increasing customer convenience, enhancing security, and streamlining banks' processes. NEFT. NEFT means National Electronic Funds Transfer. NEFT is a national-wide payment system for transferring funds electronically in batches. For example, it's widely used in India for business-to-business and personal transfers. RTGS. RTGS means real-time gross settlement. RTGS allows large value fund transfers to be settled instantly without netting. For example, it's used for high value payments like corporate settlements and government transactions. IMPS, Immediate Payment Service. IMPS provides 24/7 instant interbank electronic transfers even on holidays. Example, customers in India can transfer funds via mobile banking apps instantly. UPI. UPI means Unified Payments Interface. UPI enables seamless real-time bank-to-bank transfers using just a mobile number or virtual ID. Example, apps like PhonePe, Google Pay, Paytm rely on UPI for instant transactions in India. Mobile wallets. Wallets store money digitally, enabling online and offline payments without using bank details. Example, PayPal, Paytm, and Apple Pay allow wallet-based shopping and bill payments. QR code payments. QR codes allow customers to scan and pay directly from bank accounts or wallets. Example, small businesses in India use UPI QR codes for easy customer payments. Contactless payment card payments. Tap and pay cards use NFC for transactions without inserting the card. Example, MasterCard contactless allows payments under a certain limit with just a tap. Cross-border payments. Traditional cross-border payments via SWIFT are slow and costly. New technologies like blockchain-based RippleNet provide near instant transfers with lower fees. This is transforming international banking. Example, Ripple blockchain enables near instant global transfers with reduced fees. SWIFT network. SWIFT is a messaging system used for secure international bank communication. For example, over 11,000 institutions worldwide use SWIFT to process cross-border transactions. Digital currencies, CBDCs. Central banks are experimenting with digital currencies for faster and secure settlements. For example, China's digital yuan is being tested for retail payments. Cryptocurrencies in banking. Though not fully regulated, cryptocurrencies like Bitcoin are being explored for decentralized payments. For example, some banks allow crypto custody services for investors. Peer-to-peer P2P lending platform. P2P platforms directly connect lenders with borrowers online, cutting out traditional banks. Platforms like Lending Club in the US make it possible for individuals to lend money with better interest rates. Buy now, pay later BNPL services. BNPL lets customers split purchases into installments without credit cards. Companies like Klarna and Afterpay partner with e-commerce platforms to provide this flexible payment option. Bill payment innovations. Modern banking apps now allow users to pay electricity, water, gas, and other utility bills easily. In India, Bill Pay integrates multiple service providers into one convenient platform. E-commerce and banking integration. Banks now partner with e-commerce platforms to offer instant checkout, financing, and cashback offers. For example, Amazon Pay collaborates with banks to make one-click payments and EMI options possible. Payment gateways. Gateways enable online businesses to accept debit, credit, and wallet payments securely. For example, Razorpay and Stripe provide secure gateways for online merchants. AI in payment systems. AI helps banks monitor transactions in real time and detect suspicious activity instantly. For example, Visa uses AI to analyze billions of transactions per second to detect fraud. Future of payment systems. Payments are moving toward real-time cashless and borderless systems. Blockchain and CBDCs are expected to play a major role in the upcoming years. The goal is to make transactions faster, safer, and globally accessible. Integration of blockchain and CBDCs is expected to dominate the next decade. Section summary. Digital payment innovations like UPI, wallets, blockchain, and CBDCs have revolutionized transactions. The focus remains on making payments faster, safer, and globally accessible. They have reduced dependence on cash and made payments more convenient. Security risk and compliance. Importance of security in banking. So, security is the foundation of digital banking because banks handle highly sensitive financial data. A single breach can cause financial losses and damage customer trust. Therefore, cybersecurity measures are non-negotiable. Cybersecurity in modern banking. Cybersecurity includes strong encryption, firewalls, and intrusion detection systems to protect digital transactions. For example, banks use SSL, TLS encryption to secure online banking portals. Common cyber threats in banking. Threats include phishing, malware, ransomware, and identity theft. A major example is the WannaCry ransomware attack affected multiple attack in 2017, which impacted financial institutions worldwide. These threats highlight the need for constant vigilance. Multi-factor authentication (MFA). MFA adds extra layers of protection by requiring two or more verification methods, such as OTPs, biometrics, or security tokens. Most banks in India use OTP-based second-factor authentication for online transactions. Biometric security. Biometric technologies like fingerprints, facial recognition, and iris scans provide an extra level of login security. Example, HSBS uses face recognition to let customers securely access their mobile banking apps. Tokenization in payments. Tokenization replaces sensitive card information with random tokens during transactions. This reduces fraud risk significantly. Apple Pay and Google Pay use tokenization for every tap to pay transaction. Blockchain for security. Blockchain's decentralized and immutable nature ensures transaction records cannot be tampered with. Some banks now use blockchain for trade finance, which guarantees transparent and fraud-proof documentation. Fraud detection systems. AI-based fraud detection systems unusual activity by analyzing transaction patterns in real time. For example, Mastercard uses AI to flag and block suspicious transactions before they are completed. This strengthens fraud prevention. AML, anti-money laundering. Banks must follow AML rules to detect and prevent money laundering activities. AI-based tools now scan and analyze customer transactions to identify unusual or illegal fund transfers. KYC, know your customer. KYC ensures proper customer identity verification before offering banking services. Today, many banks have adopted video KYC, allow customers to open accounts remotely without visiting a branch. RegTech in banking. Regulatory technology automates compliance monitoring and reduces reporting errors. For example, AI-driven RegTech platforms can quickly identify suspicious money laundering patterns, saving banks both time and resources. Risk management in banking. Risk management includes digital tools now help banks manage credit risk, market and operational risk more effectively. For example, AI models can predict a customer's loan default risk by analyzing repayment history and spending patterns. Data privacy regulations. Banks must comply with strict regulations like GDPR in Europe and RBI guidelines in India. Non-compliance can lead to heavy penalties and reputational loss. Regulations also protect customers and ensure financial stability. Cloud security in banking. With cloud adoption, securing data stored remotely is critical through encryption and secure access controls. For example, banks using AWS or Azure rely on banking-grade security protocols for compliance standards. Insider threat management. Not all risks come from outside. Sometimes employees mishandle or leak data. Monitoring systems are used to detect unusual staff access to sensitive customer records. Strong internal controls are essential for trust. Monitoring systems detect unusual staff access to sensitive information. Zero Trust Security Model. Zero Trust means no user or device is trusted by default, even inside the bank's network. Every login or data request must be verified. This reduces the chances of unauthorized access or cyber attacks. Role of AI in compliance. AI tools now automate compliance checks by scanning thousands of trades and transactions. This ensures legal standards are met without delay. For example, AI systems flag potential violations before they cause regulatory issues. Cybersecurity training for staff. Many cyber attacks start with phishing emails or social engineering. Banks regularly train employees to recognize suspicious activity. Awareness is one of the strongest defenses against cybercrime. Banks regularly train staff to identify and report suspicious activities. Challenges in security implementation. Security implementation is high cost, uh, evolving threats and customer resistance to stricter security measures remain key challenges. Despite strong measures, banks still face challenges like high cost, evolving threats, and customer resistance to stricter rules. The key is to balance strong security with user convenience. Balancing security with user convenience is a continuous struggle for banks. Customer service transformation. Technology has moved banking from long ways in branches to instant service through apps and chatbots. Customers now expect 24/7 support, fast problem resolution, and personalized services. 24/7 availability. Online and mobile banking platforms allow customers to access services anytime, removing time restrictions. Online and banking platforms allow customers to, without being restricted by branch hours. For example, UPI payments let customers transfer funds at midnight instantly and securely. Chatbots for customer support. AI-powered chatbots answer FAQs, guide transactions, and provide reminders for payments. For example, Bank of America's Erica chatbot supports customers with bill reminders and financial insights. Personalization of services. With the help of data analytics, banks customize loan offers, investment advice, and other services. Customers now receive tailored solutions rather than one size fits all products. Faster loan approvals. Automated systems use AI to check credit history and approve loans in minutes. For example, instant personal loan approval is now possible via apps like HDFC's digital loan services. Customers now receive tailored solutions rather than one size fits all products. Virtual relationship managers. Banks provide digital relationship managers through apps and video calls for premium customers. Example, Kotak 811 offers a virtual relationship manager for online account holders. Banks now offer virtual relationship manager through apps for premium customers. Financial inclusion. Financial inclusion through technology has helped banks reach rural and underserved populations. Initiatives like India's Jan Dhan Yojana used digital platforms to open millions of bank accounts for low-income households. Customer empowerment. Customers now manage accounts, investments, and credit cards independently via mobile apps. This reduces dependency on staff while increasing transparency and customer empowerment. Digital onboarding. Digital KYC and video verification now make account opening fast and easy. For example, SBI's YONO app lets customers open accounts without visiting a physical branch. Omnichannel banking. Customers can banks now provide seamless services across ATMs, mobile apps, websites, and branches. For example, a customer can start applying for a loan online and finish the process at a branch without starting over. This consistency improves customer convenience. Multilingual banking services. Multi-language support banking services, banking apps, and IVR systems now support multiple languages to reach more customers. Mobile apps and IBR systems offer multiple languages to increase accessibility. In India, UPI apps are available in over 10 regional languages, making digital banking more inclusive and user-friendly. Enhanced transparency. Transparency in services provides, like digital banking, provides customers with real-time updates on transactions, charges, or loan details. Customers can track EMI breakdowns and repayment schedules online, improving trust and financial awareness. Mobile-based customer support. Banks now connect with customers through video calls, chat, and in-app support. For example, IndusInd Bank's video branch allows customers to interact with staff without visiting a physical branch. Integration with social media. Social media banking allow account services through WhatsApp and social media. For example, HDFC Bank provides balance checks and mini statements via WhatsApp banking, making services more accessible. Smart notifications. Smart notifications or push notifications inform customers about spending patterns, duties, and suspicious transactions. It's also helpful for bill reminders. Apps like Google Pay notify users immediately when money is credited or debited, ensuring better financial control. Gamification of banking. Banks are using gamification to make finance engaging. Apps like FI Money reward users with points for saving regularly. This encourages good money habits among customers. Challenges in customer service technology. Despite technology, challenges remain such as customer frustration with of over-reliance on automation and the digital divide in rural areas. Balancing automation with human support is essential for better satisfaction. Digital divide in rural areas still limits full customer adoption for modern banking technology. Section summary. Summary of customer service includes technology has improved accessibility, personalization, and convenience in banking services. However, the future challenge lies in combining automation with a human touch to keep customers satisfied and loyal. This challenge ahead is balancing automation with a human touch for customer satisfaction. Personalized customer service. Personalized services via AI is important for all. Banks now use AI to tailor recommendations for loans, investments, or credit cards. For example, chatbots can suggest financial products based on customer spending patterns. This enhances customer engagement. Real-time data analytics. Banks leverage analytics to instantly detect fraudulent transactions and optimize operations. For example, suspicious login attempts are flagged immediately, protecting both the bank and its customers. Banks leverage real-time analytics to detect fraudulent activities and optimize transactions instantly for customer services. Predictive analytics for credit risk. Advanced analytics helps banks predict loan repayment ability. This reduces default risk and improves lending decisions. For example, using AI to assess customer repayment history and spending to evaluate credit worthiness. Enhanced loan processing. Faster loan approvals is help to customers. Loan applications and processing the loan faster, making approvals transparent and quick. Many banks now offer instant loan apps that approve and disburse funds within minutes. Digital transformation in rural banking. Technology bridges the urban-rural divide, bringing banking services to remote areas. Mobile vans and digital kiosks extend banking services to rural areas. These innovations ensure that people in remote regions also benefit from modern financial services. AI-powered investment guidance. Robo-advisors use algorithms to provide automated investment advice based on customer goals. Platforms like Go and Zerodha offer customized portfolio suggestions, making wealth management accessible to everyone. Automated fraud detection. AI systems quickly analyze transaction patterns to identify unusual activity. For example, if a stolen credit card is used in two different countries within minutes, the system can block it instantly. This real-time detection prevents major losses. Digital signatures in banking. Digital signatures mean e-signatures replace physical paperwork with secure digital signing. Customers can open accounts or approve transactions remotely. This speeds up processes while maintaining legal security. For example, opening bank accounts without visiting branches. Chatbots for 24/7 banking assistance. Banks deploy AI-powered chatbots to answer customer questions anytime. For example, HDFC Bank Seva chatbot, for instance, can handle millions of queries, reducing call center pressure and improving response times. Cloud-based core banking systems. Cloud technology in banking uh, helps to provide scalability, lower cost, and constant availability. Small banks especially benefit as they can expand services without having investments in hardware. Cloud adoption is now a global trend. For example, small banks using cloud platforms to expand operations quickly. Multi-language digital banking. Banks increasingly offer apps and services in local languages to improve accessibility. For example, UPI apps in India support multiple regional languages, making them usable for rural populations as well. Automation of regulatory compliance. RegTech for compliance is important for people, automates compliance processes, reducing human errors. AI-driven RegTech systems are used for anti-money laundering checks, ensuring banks stay aligned with strict regulations. Gamification in banking apps. Banks use gamification to engage customers and encourage savings or investments. For example, apps rewarding points for saving regularly. This makes banking more interactive and engaging. Social media in banking. Social media integration are now important for banks. Banks are now integrating services with platforms like WhatsApp and Facebook. For example, ICICI Banks allows basic services like balance checks and fund transfers through WhatsApp Bank. Contactless ATM withdrawals. Banks now enable cardless ATM withdrawals using QR codes or mobile apps. SBI's Inno app, for example, allow customers to withdraw money without carrying a physical debit card. Blockchain in trade finance. Blockchain ensures secure and transparent trade finance transactions. HSBC uses blockchain to settle trade deals, reducing fraud risks and eliminating unnecessary paperwork. Insurance technology. InsurTech is banking. In banking, banks integrate InsurTech to offer customized insurance products digitally. It ensures a secure and transparent trade finance transaction. For, ex- for example, customers can purchase customized policies like auto or health insurance directly through bank apps in just a few clicks. Voice-enabled banking services. AI-powered voice assistants allow customers to perform banking tasks using voice commands. For example, Alexa-enabled services let customers check balances or transfer funds verbally. Green and sustainable banking. Green banking through technology. Digital banking reduces paper use and carbon footprint, contributing to sustainability. Digital banking reduces paper use to support eco-friendly practices. E-statements, online forms, and digital signatures all contribute to lowering banks' carbon footprints. For example, e-statements instead of physical account statements. Role of AI in fraud detection. Artificial intelligence can detect unusual patterns in transactions that might indicate fraud. Machine learning models continuously learn from historical fraud data to improve detection accuracy. If an unusual transaction pattern is spotted, the system immediately raises alerts protecting customers. For example, AI alerts a bank if a card is used into distant countries within minutes. AI-powered chatbots in banking. Chatbots provide instant customer service anytime of the day. They handle queries about balances, transactions, or loan eligibility. For example, HDFC's Eva chatbot reduces the need for physical call centers. AI in credit scoring. AI evaluates creditworthiness by analyzing more than just credit history. It uses spending patterns, digital footprints, and alternative data to make accurate decisions. Fintechs use this to provide instant loan approvals. AI for risk management. Predictive analytics in risk management identifies high-risk customers or sectors before defaults happen. Predictive analytics powered by AI helps banks assess and mitigate risk. It identifies customers or sectors with high default probability. For example, AI models flag risky loan applications, helping banks minimize losses and make safer lending choices. AI in personal finance management. Banks now offer AI-driven budgeting tools that categorize expenses into food, travel, or shopping. Banks use AI to provide budgeting tools, spending analysis, and savings recommendations to customers. This helps customers manage spending and receive tailored savings recommendations for better financial habits. For example, apps that categorize expenses into food, travel, shopping, etc., to guide better financial habits. AI in algorithm trading. AI analyzes large amounts of financial market data to execute high frequency trading strategies. This increases efficiency and maximizes returns for investment banks. Artificial intelligence analyzes vast financial data to enable high frequency trading. This boosts efficiency and returns for investment banks while also reducing the chance of human error in decision making. AI in loan underwriting. AI evaluates loan applications faster by automating document analysis and income verification. This speeds up loan disbursement and improves customer satisfaction. Artificial intelligence analyzes financial analyzes loan application reviews, verifying documents and income details instantly. This reduces processing time from days to minutes, making customers happier and banks more efficient. Also, this speeds up loan disbursement and improves customer satisfaction. AI in customer behavior prediction. Banks use AI to predict which products a customer may be interested in. This allows personalized recommendations for credit cards, loans, or investment products. Banks use AI to predict what products customers may need, their choices or preferences, like credit cards, loans, or investments. Personalized offers increase customer satisfaction and also improve sales. AI in document verification. AI scans and verifies documents like ID proofs, PAN cards, Aadhaar automatically. This reduces errors and makes KYC faster and more secure. AI for KYC verification is very important for now. AI scans and verifies documents automatically. This reduces errors, speeds up on customer onboarding, and ensures compliance with regulations. Role of machine learning in banking. Machine learning models analyze patterns in customer transactions to improve predictions. Applications include fraud detection, investment recommendations, and credit risk assessment. It means machine learning models continuously improve by analyzing past customer behavior. They are used for fraud detection, credit risk assessment, and personalized investment recommendations. Predictive analytics in banking. Predictive analytics forecast customer needs, helping banks offer relevant services. For example, predicting when a customer might need a car loan based on spending behavior. Predictive analytics forecast when a customer might need financial products such as a car loan or insurance. This allows banks to proactively offer relevant solutions at the right time. Natural language processing (NLP) in banks. NLP helps banks process unstructured data like customer complaints and emails. It is also used in voice-enabled banking assistance. Example: SBI's voice-based banking. NLP helps banks analyze unstructured data like emails, complaints, or voice calls. It also powers voice-enabled assistance. For example, SBI has voice-based banking services for its customers' health. Biometric authentication in modern banking. Banks use biometrics like fingerprint, face recognition, ID scanning for secure login and transactions. It's are now widely used for secure transactions. For example, Face ID on mobile banking apps ensures that only authorized users can log in. Role of cloud computing in banking. Cloud adoption in banking is very important. Cloud technology helps banks scale quickly, reduce infrastructure cost, and provide uninterrupted services. Cloud technology allows banks to scale IT infrastructure, reduce cost, and improve data accessibility. For example, banks hosting digital services on AWS or Azure. Many banks use AWS or Azure to host digital services while ensuring high security. Hybrid cloud in banking. Many banks use hybrid cloud, a mix of private and public cloud, for better security and flexibility. This balances sensitive data storage and customer-facing applications. Many banks adopt hybrid cloud setups combining private and public clouds. This lets them keep sensitive customer data secure while running customer-facing apps efficiently. Cloud-based core banking systems. Banks are shifting from legacy systems to cloud-based core banking platforms. This improves speed, flexibility, and customer experience. This improves speed, flexibility, etc. By allowing instant updates and remote access. Data analytics in banking. Banks use big data to analyze customer behavior, manage risk, and improve marketing strategies. For example, targeted offers for credit cards based on spending history. Banks use big data analytics to study customer spending, customer behavior, manage risk, and design customer marketing campaigns. For example, targeted credit card offers details based on past purchase history for customers. Blockchain in cross-border payments. Blockchain reduces the time and cost of international payments by eliminating intermediaries. Blockchain reduces both time and cost of international transfers by cutting out intermediaries. RippleNet is now such a solution that enables near instant global transactions. This technology is transforming traditional SWIFT-based systems. For example, Ripple is used by banks for fast global transactions. Smart contracts in banking. Blockchain-based smart contracts automate agreements between banks and customers. They ensure transparency and reduce legal disputes. Blockchain-based smart contracts automatically execute agreements once conditions are met. This reduces paperwork, ensures transparency, and minimizes legal disputes between banks and customers. Cybersecurity in digital banking. As banking moves online, cybersecurity technologies like firewalls, encryption, and intrusion detection systems protect customer data. As banking shifts online, technologies like firewalls, encryption, and intrusion protect customer data for helping customers. These measures are critical to uh, prevent hacking, fraud, and data breaches in the financial sector. Multi-factor authentication (MFA). Multi-factor authentication MFA adds extra layers of security such as OTP, biometrics, or security tokens beyond passwords. Example: login requires both password and OTP. Multi-factor it means multi-factor authentication strengthens security by requiring more than just a password to log in. It typically combines two or more elements, something you know, password, something you have OTP or token, and something you are biometric. For example, customers logging into net banking often need both a password and a one-time code sent to their phone. NSA makes it significantly harder for a hacker to access accounts even if one layer of security is compromised. In an era of rising cybercrime, MFA is becoming mandatory across digital banking platforms worldwide. This method ensures a balance between convenience and strong protection. Role of fintech startups. Fintech partnerships is also important for people. Traditional banks are increasingly partnering with fintech companies to stay competitive in the fast-changing financial landscape. Fintech specialize in innovative services like mobile wallets, peer-to-peer lending, instant credit, and robo-advisory. For example, Paytm and PhonePe in India work closely with banks to provide digital wallets and UPI services. These collaborations allow banks to expand their digital reach while fintechs gain regulatory backing and customer trust. Partnerships also promote financial inclusion, bringing modern banking to underserved areas. Over time, these hybrid models will dominate the sector by combining trust and innovation. Open banking APIs. Open banking allows third-party apps to access customer data securely through APIs. For example, customers using budgeting apps that link directly with their bank account. It means open banking is a system where banks share customer data securely with third-party apps through APIs. APIs means application programming interfaces. With customer consent, budgeting apps, investment platforms, or e-commerce services can directly connect to bank accounts. For example, in the UK, open banking has allowed customers to link accounts with apps that provide lending insights and financial planning. This promotes competition and innovation while giving customers more control over their financial data. However, it also requires strict regulation and cybersecurity safeguards to ensure privacy and security. Open banking is expected to redefine financial ecosystems globally. Contactless payments. NFC-enabled cards and UPI QR codes allow faster, secure, and tax-free payments. For example, Google Pay, Tap, and Pay. It means NFC means near-field communication and QR-based payments are revolutionizing small-scale retail transactions. NFC enables quick contactless payments where customers simply tap their card or phones on a payment terminal. QR codes instant payments by scanning codes through mobile banking or wallet apps. In India, UPI QR codes are widely used by because they are simple and cost effective. Technology saving cash dependency improve transaction speed and increase convenience for both customers and merchants. Together, NFC and QR payments are pushing banking closer to a fully cashless economy. Role of robotics in banking. Robots automate repetitive banking processes like data entry, compliance checks, and document processing. For example, RBI boards processing loan applications. This means RBI uses a software robots to automate repetitive and based tasks in banking. Common applications include KYC verification, loan processing, compliance checks, and data entry. For example, bank uses RBI to accelerate trade settlements, reducing both cost and human error. RBI allows employees to focus on strategic tasks while routine work is handled automatically. It significantly improves efficiency and consistency, especially for high volume processes. As more banks adopt RPA, back office operations will become faster, more accurate, and cost effective, leading to better overall productivity in the sector. Clean banking technology. Technology helps reduce paper use through e-statements and digital signatures. Green banking promotes sustainability and eco-friendly practices. It focuses on sustainability and reducing environmental impact through digital solutions, moving from paper statements to e-statements, promoting digital signatures and offering online forms as part of eco-friendly banking practices. For example, banks encourage customers to opt for digital receipts instead of printed ones, cutting paper waste. Banking also includes supporting renewable energy projects through financing and investments. These initiatives not only reduce operational costs but also enhance global sustainability goals. By adopting these strategies, banks increase their public image while contributing to environmental protection. Future of technology in banking. Banking will move towards hyper-personalization and for advisory and cashless transactions. Technology will make banking faster, fully cashless transactions. Customers may receive financial services tailored to their lifestyle and spending habits. Scale will predict customer needs, while blockchain and CBDCs, central bank digital currencies, will make payments instant and borderless. Biometric authentication will further improve security and cloud platforms will enhance scalability. With these changes, banks will pivot from being service providers to financial partners in people's daily lives. This future promises a faster, safer, and smarter banking for everyone. Case study: API in India. The background of the case study is launched by NPCI, National Payments Corporation of India, in 2016. Unified Payments Interface API allows instant banking transfers using mobile. So, Unified Payments Interface API was launched by NPCI in 2016 as a digital payment system. It allows instant bankable transfers using just a mobile phone or virtual ID. In 2016, UPI processed around 2 million transactions monthly, but by 2023, this number had grown to 10 billion per month. Its success lies in its simplicity, pay transfers, and 24/7 analytics. UPI is widely adopted by apps like PhonePe, Google Pay, Paytm, making digital payments accessible to small shopkeepers and rural populations. This system has become the backbone of India's digital economy. So, is the background the case study, which is Ukraine in India, and their impact from 2 million transactions in 2015 over 10 billion transactions per month. Adopted by all major banks and third-party apps including Google Pay and Paytm. Its enables financial inclusion with small vendors and rural merchants access digital payments via QR code. It explains that UPI has transformed India by giving digital corner of the country. Small vendors and even offline merchants now accept UPI payments through QR codes, reducing dependency on cash. It has improved transparency in transactions and encourages people to shift from cash to digital modes. UPI's widespread happening has boosted India's digital economy and set a benchmark for other nations. Its fully increasing urban rural financial access is unmatched. Banking is making it a model for digital payment innovation worldwide. Global innovation of UPI. UPI is started by countries like Singapore, UAE, transfer adoption. India's position is as a model for real-time payments globally. So UPI has not only success in India, but is now attracting global attention. Countries like Singapore, UK, and UAE and France are studying this framework for possible adoption. India's positioning UPI as a global standard for real-time payments, showcasing the strength of its API-driven infrastructure. Its low-cost model and practice of make it attractive for developing nations seeking financial inclusion. Its low-cost model and ease of use make it attractive for developing nations seeking financial inclusion. The global innovation of UPI demonstrates how technology designed market one market can inspire and transform digital finance across the world. Then, why relevant to modern banks? Showed how technology, fintech plus mobile phone transform everyday banking, reduce dependency on cash, increase transparency, and boosted digital economy. this is the case study of UPI in India, which is very important for know about conclusion. Technology has completely transformed modern life from tradition for detection to customer solution, financial inclusion. Innovations like AI, blockchain, and cloud computing will continue shaping the future of banking. So the overall conclusion is that technology has completely reshaped modern banking, shifting from branch visits and manual records to instant, secure, and digital fast solutions. Innovations like AI, blockchain, cloud, and retail have transformed payments for detection, customer service, and financial inclusion. The journey shows how customer needs, competition, and global trends drive technological growth. Safety and risk. Digital first banking will continue to evolve with hyper personalization, stronger security, and better accessibility. Banks that embrace this innovation the financial landscape. Thank you. This final slide concludes the presentation. So it's not just a closing note, but